Hey everybody, Chuck Barone, Friday, October the 7th, 2022, the day we've been waiting for this week, big jobs report. But before we get into the show, as always, I just want to thank everybody for their support for the show, for watching the videos and supporting the channel. We appreciate you guys. Markets today. Not a good day today. Jobs report making a big mess of things. Stock market down across the board. Stock investors having a sad today. The jobs report coming in a little higher than they expected, basically clearing the way for this pretty big rate increase of 3/4 coming up in November. The market's not liking that, obviously, leading to a sell-off today. Plus, I think a lot of traders wanted to get out. Traders don't like staying in the market over the weekend because something could happen that could adversely affect their position by Monday morning when they get back into the office. So I think a few traders are probably taking some money off the table too, because there's just so much uncertainty. We're getting whipsawed around with news and rumors and everything else, trying to figure out which way this market's going to go. I think that this pretty much now, the die is cast. It has been, and I've been saying it the entire time. A recession coming, and the market's starting to adjust to that reality. Bond market also in a bear market, down again today. Bond market selling off pretty, not in a dramatic way, but the bond market's been in a pretty steady sell-off over the last 6-8 weeks or so. The 10-year settling at 3.88% today, up 5 basis points. The 2-year, which we've been using it to compare, sitting at 4.31%, up 6 basis points today. So the spread a little bit wider. You got 43 basis points between them. The inverted yield curve looks just so weird, guys. It's not a normal market, and it's this inverted yield curve, especially being as wide of an inversion as it is just basically screaming a warning to us that this recession's coming, in spite of all the stuff we've been hearing. And we're going to get into a little bit of that in the commentary. The dollar today up again, it's on a roll, almost up to 113 on the index, just kicking the crap out of every other currency out there, putting a lot of pressure on other governments, debt markets, commodities markets, and everything else. So with the dollar being up again today, metals down today. Gold sitting at $16.96 per ounce, down $17.80 today, breaking support at that $1,700 mark. That's disappointing. Silver sitting at $20.22, down 51 cents today, holding support at 20. I think the last time they broke through, gold went down first and silver followed. I think that right now, the way the metals markets work, and I hate to say this for you metal bulls out there, but it's all contingent on the dollar, guys. Now, the good news is, in metals at least, I don't know how much higher the dollar can go. And as the dollar starts to come down to earth, which it ultimately will, I think that metals will have a pretty nice rally. I think they really want to rally. I think there's powder and money sitting on the sidelines wanting to invest, just waiting for an opening. And I think that as this dollar comes down, when it starts to and does, there'll be an opening for metals investors. Oil today up $92.64 for a barrel of West Texas Intermediate. The big threat from the OPEC Plus, of course, the reason for this bump. I'm not so sure if I would take OPEC too seriously, guys. I think that the oil companies and the refineries and everybody in the U.S. is looking for any reason they can to raise prices. So they're looking for any little bit of rumor. OPEC hasn't even been making their quotas, so I don't know how much a cut is going to affect the prices and the actual supply of oil. But nonetheless, oil up today. Natural gas down today, which is a surprise to me, down over 3% to $6.74 for their million BTUs. I'm surprised. Natural gas made a high earlier, well over $9. Now it's come, it's been working its way back down. It's actually up a little bit from the low, the recent low. And I'm surprised. I really figured that with winter coming, we're into October now, the demand for natural gas would be outrageous. Apparently the market's not reflecting that, so not yet, guys. Bitcoin down a small today, sitting at 19,600. Bitcoin looking for a place to go, following the market again. It just is what it is with Bitcoin. I think that Bitcoin needs a reason to rally, and until it finds one, it's going to kind of be stuck here. Getting to the news that you guys need to know today. The big news today, obviously, the jobs report. Coming in higher than expected. Coming in at 263,000 jobs. It's pretty much cementing now this rate bump, the three-quarter point rate bump in November. So you guys can start planning on that. It's likely going to happen. This month's jobs report was weaker than it's been, but still higher than they expected. Job growth, obviously, still pretty robust. Even though they say there's more than 1 million job openings have vanished, there's still 10 million job openings looking for people to fill them. This is what's keeping the economy going. Obviously, if companies were not making profit, they wouldn't be looking to hire. So this goes to this weird mixed signals thing we've been getting on this economy, where it just seems like things are really bad. I guess inflation creating this gloom and doom kind of vibe to everybody, where everybody hating paying more, especially with gas prices skyrocketing back up, food prices, stuff we deal with every day. But the economy itself, it seems like companies are earning money. They want to hire people. So it's just creating a weirdly mixed signal vibe to the markets where who the hell knows? But one thing we do know is, barring some real calamity, these rate hikes coming up for the rest of this year, 3/4 in November, 0.5 point in December, I think are pretty much in cement now. So expect these rate hikes coming and adjust your portfolio and your thinking accordingly. Interestingly, as I was reading the jobs report, it said that the United States has added 2.3 million jobs in the past 6 months. That's a really big number, guys. That is more than any 6-month period going back 20 years prior to the pandemic. Or the scamdemic, however you feel. But job growth is still pretty robust, even though this month's report was a little lower. We're not losing jobs, that's for sure. And we're going to have to see that, I think, before we get this inflation number under control. But I just thought that was interesting, that to give you guys an idea of how much job growth has really happened. The best 6 months in the past more than 20 years. Now remember this, guys. Here's the thing to remember. The rate hikes that the Federal Reserve has been implementing, the rate hikes alone are not going to do anything to bring inflation down. They're not. They're going to make everything more costly. They're going to slow demand for money down, but they're not going to bring down inflation just with rate hikes. What happens is the Fed is going to raise rates high enough to create a recession. And the recession then, depending on how deep it is, that's why they talk about soft landing, hard landing, and all this stuff. Their Fed jargon, right? But the Fed has to induce a recession to bring inflation down. The last time we had inflation rates like this, we had to have a pretty strong recession. We'll see how this one works out coming up. But know that rate hikes don't do anything except bring on the recession, which then brings demand down, which then, of course, brings down prices. So keep that in mind as you're hearing about these rate increases. And, you may have wondered, how do rate increases bring inflation down? They don't. Rate increases bring a recession, and the recession then brings prices down. Interesting note today. I was reading an article. I've been a mortgage broker and been doing loans for a long time here in Las Vegas. And I was a victim and a participant in the big 2008 housing crash. I was reading an article today. It said Bank of America has finally agreed to settle a suit going all the way back to the 2008 housing crisis. They've been litigating this thing for 14 years against a bond rating agency who accused Bank of America of using subpar underwriting standards for these insured bonds that were rated AAA. Bank of America agreed to pay $1.84 billion to settle this suit. I can see why they litigated it for so long. But when you agree to settle a suit like this for that much money, we can kind of take that to believe that Bank of America, along with a lot of other lenders way back then, were really just jamming loans through. They were getting the ratings agencies to stamp them all AAA. And we all know, those of us old enough to remember 2008 and the aftermath all the way till 2012, what those poor underwriting standards and that real estate mania created then. Very unhappy, and now Bank of America got to pay the piper to the tune of $1.84 billion. And finally today, guys, there's a lot of fear in the markets. As I've been explaining since we started this blog, there's really only two motivators when it comes to the market and pretty much everything in life. It's either fear or greed. Well, we've had the greed going in the markets for real estate and everything else for a long, long, long time. Well, now with these rate increases, the fear is taken over. That's why you're seeing big changes in the equity markets, in the bond market, and pretty much everything coming down. Confidence is not soaring right now in our financial markets. But I was reading, this was really interesting. They said that investors sold over $7 billion in equity funds in just the past week. So investors are pulling their money out of the stock market, pulling their money out of equity funds. I think that a lot of them are keeping their powder dry. They're certainly not rushing into the bond market. I don't believe that. From the looks of the way we've been following things here, they're not rushing into precious metals. So the money is parking, looking for a place to go. What's interesting was the previous month, equity funds were up $4 billion in deposits. Now down $7 billion in the past week. Gives you an idea of the state of the markets right now. There's just so much uncertainty. There's so much mixed signals. There's so many things to try to consider. I tell you this, guys, going back to our very first show, the strategies we've been espousing, trying to get you guys to understand and follow, are the strategies that are going to work. Very, very basic stuff. Stuff designed more for people who think more like the investor, like a Warren Buffett type of investor, buy it and hold a good company, rather than a trading type who are looking to be in these markets every day, trading in and out of positions. Our mantra goes like this. Let me repeat it all real quickly. Step 1, save as much of your income as you can, the target being 10% of your income. I understand that times are tough right now and people are operating on very thin, living paycheck to paycheck. But if you can find a way to save even $100 a month, that's the way you get started. I've told my personal story. I started bringing my lunch to work every day instead of going to lunch. It saved me a lot of money. It started me on my fund, and I still have it, right? I still bring my lunch every day. Saving 10% or as much of your income as you possibly can. Investing your money conservatively. Trying to get into defensive positions. We've talked about preferred stocks. We've talked about high dividend, consumer non-durables, food and soap. We've talked about medical stocks. We've talked about utilities. These are the places they're going to kick you in income. When the market tanks, they don't decline as quickly. They're good defensive positions. We've been talking about that. We've been talking about trying as much as you can to not take on any new debt. Now, I know it's difficult to pay debt down, especially when you're trying to save a few bucks at the same time. But the idea being, try as hard as you can not to add new debt on, because this debt is getting more expensive, and it's going to continue to get more expensive, making it more and more and more difficult to get yourself out of debt, right? And lastly, we've been recommending just to live your life a little more conservatively. And I don't mean politically conservatively. I mean just, trying to find the simple pleasures in life rather than having to go out and spend a lot of money to amuse yourself. We've been talking about, just being more thoughtful about the things you do. Being more thoughtful about the way you spend your money. And trying not to do these impulsive buys, but really rather, taking a minute to think it over. Do I need this or do I want it? Because now's not the time for want stuff, guys. Now's the time for taking care of what you need and trying to bank the rest. Because when this recession's over, I promise you guys, all of your desires that you've been pushing back and delaying gratification on, you're going to get bargains on all of it. Because when this is done, I feel like everything is going to be a lot cheaper than it is now, even with this inflation. I mean, let's face it, housing is one of the biggest drivers of inflation. It's starting to come down. Prices in Vegas are already down $30,000, $35,000 from the median. Going to continue their way down as these rates continue to rise. So, be patient, guys. Know that the storm is here and coming, going to get worse. It's not the end of the world, however. It's not the end of the system. It's not the end of, we got so many guys on YouTube talking about basically the end of everything. This is a recession, guys, not the end of the world. It's going to be a tough one. There's going to be people who suffer. There's also going to be people who thrive, especially when the recession's over and they're in a position to take advantage of the opportunities. Anyway, that's it for this Friday, guys. We appreciate your support, as always. If you like what you're hearing, hit the like button. Share these videos with your friends, your subscribers. If you haven't already, subscribe to the channel, hit the notifications. If you have questions, simple questions, ask them in the comment section. More complex questions, ask Chuck Barone at gmail.com. It's going to be a great weekend. I'm really looking forward to it. I'm tired. It's been a long week this week. Bill's got the Steelers on Sunday. We're going to win. Have a great weekend, everybody. Try to relax and not think about these markets or the economy or the government or any of this craziness going on for a couple of days, because we're going to have plenty to deal with next week. We'll get GDP numbers for the third quarter next week and all kind of interesting stuff. So have a great weekend. Rest and relax. We'll talk to you guys again Monday. Until then, take care. Thanks.